Hi, I'm Tess Downing, founder of Complete View Financial, and welcome to this month's video blog. Today I'm going to talk about how to safely spend from your portfolio in retirement, and we're talking about safe withdrawal rate analysis. So I first want to start with a little bit of the history of the safe withdrawal rate research. Many refer to William Bengen as the father of the safe withdrawal rate analysis. He was reading a lot of misguided claims in the popular press in the early 1990s that if stocks were averaging 7% after inflation, then plugging a 7% return into a spreadsheet suggests that retirees could withdraw 7% each year without ever dipping into their principal. Bengen recognized the problem with this calculation because it ignores the real-world volatility experienced around that 7%. And he sought to determine what would have worked historically for hypothetical retirees at different points in the past. He used Ibbotson Associates data extending back to 1926 for U.S. financial markets. His research introduced the concept of sequence of returns risk to the financial planning profession. He found that with a 50-50 asset allocation to stocks using the S&P 500, and a 50% allocation to intermediate-term government bonds, the worst-case scenario experienced in the U.S. history was for a hypothetical 1966 retiree who could have withdrawn at maximum 4.15%. Thus, we have what is known as the 4% rule. Here's a great chart showing that research. So essentially, what is the highest withdrawal rate amount as a percentage of retirement date assets that with inflation adjustments would have been sustainable for the full 30 years in retirement? So he looked at rolling 30-year periods from history from 1926 to 1955, 1927 to 1956, and so on. And what you can see here is that in 1966, that was the worst historical scenario, resulting in that 4% withdrawal rate. This next chart shows it a little differently, and essentially what is the terminal value of a 60-40 portfolio or the ending value of that portfolio after 30 years spending 4% initial withdrawal rate. And what you can see is in 1966, that portfolio still had some money left over by safely spending at that 4% level. So here's a quick example to apply to your own portfolio. In the first year, spending 4% of a $1 million retirement portfolio, you could initially withdraw $40,000. In the second year, we take that $40,000, apply it to an adjusted inflation of 2.5%, and we are now able to withdraw $41,000. In the third year, the same rule applies. We take that $41,000 and adjust it by inflation and get a third year spending number of around $42,000. So what are some of the factors that can impact how much you can safely spend in retirement? So sustainable spending rates for retirees depend on many factors, asset allocation being a prime example. You can't be too conservative in retirement to sustain a 4% rate. As I mentioned earlier, you need at least a 50-50 or a 60-40 to start at that initial 4% rate. If you're any more conservative than that, then you'll have to reduce your initial rate. Other factors, such as market valuations and current interest rates, desired spending patterns over time, the degree of budget flexibility, that if you're willing to tighten your belt during down markets and spend less, or when markets are doing really well, you take that big trip, that has a huge impact over time. And the desire to preserve a portion of the portfolio, say for a future inheritance, or the length of the planning horizon, or essentially your life expectancy. So essentially, flexibility with spending creates synergies that allow for a higher initial spending rate. So what does the current research actually tell us? So the 4% rule has a planning horizon of 30 years. We know people are living longer and longer these days, and so many are saying that 30 years is no longer long enough. We now need to plan for at least a 40-year time horizon in retirement, which means 3.5% to 3.7% initial spending rates. On the other hand, other researchers indicate that if retirees truly do begin to spend less in retirement, they could possibly spend more and start at 4.5% initial withdrawal rate. And as you can see, This can get very confusing. And so this is being researched literally every year. There's new information that's coming out around this. So what do we make of all of this? Having a thorough understanding of how much you actually need to spend in retirement can be a great starting point. So creating a detailed budget. Being flexible during volatile markets can also really impact the longevity of your portfolio. And stress testing your retirement plan with bad years in the markets, good years, as well as an early death or a sickness, really stress testing that plan to make sure that it's viable. And the 4 to 4.5% rates of initial withdrawal is really a great rule of thumb to start at. An upside here is that Michael Kitces and Bill Bengen, really the leading researchers within safe withdrawal rates, have both described as a statement of confidence in safe withdrawal rates that in 96% of US historical simulations, the value of assets remaining after 30 years will be higher than the retirement date amount. So ultimately, the idea is to retire when you can meet your spending goals using what you are comfortable in identifying as a safe withdrawal rate for your portfolio. Thank you for joining me for this month's video blog.